The invisible tax destroying your wealth that nobody talks about. There is a tax being taken from you every single year. It doesn't show up on your pay stub. The IRS doesn't collect it. Your employer doesn't withhold it. But it is quietly destroying the purchasing power of every dollar you earn, every dollar you save, and every dollar you invest. It's called inflation. And most people have no idea how badly it's actually hitting them. Today, I'm going to show you the real math. And more importantly, the exact investments that beat it. Let's start with what inflation actually means in real numbers. The average inflation rate in the United States over the last 30 years has been approximately 2.5 to 3% per year. That sounds harmless, until you run the math. $100,000 sitting in a savings account earning 0.5% interest after 20 years at 3% inflation is worth approximately $55,000 in real purchasing power. You didn't lose a single dollar. Your account still says $100,000. But you lost 45% of what that money can actually buy. That is the invisible tax. And it hits hardest on people who think they're being responsible by saving money in cash. Now let's talk about how this affects different types of savers. The cash hoarder keeps $50,000 in a checking account. Feels safe. Feels responsible. After 20 years of 3% inflation, that $50,000 has the purchasing power of $27,000. The low-yield saver puts money in a traditional savings account at 0.5%. After 20 years, purchasing power of about $33,000. The high-yield saver uses a high-yield savings account at 4.5%. After 20 years, purchasing power of $55,000. Kept most of the value. The investor puts that $50,000 into an S&P 500 index fund. Average 10.7% annual return. After 20 years, $370,000. In real purchasing power, even after inflation, over $200,000 in today's dollars. Same starting amount. 4 different decisions. 4 completely different financial realities. Here's the part that should make you angry. The traditional advice most people were given was save money. Put it in the bank. Build a nest egg. And that advice, in a world with persistent inflation, is wealth destruction in slow motion. Saving money in cash is not safe. It is a guaranteed losing strategy against a 3% annual inflation rate. The only way to beat inflation is to own assets that grow faster than it. And that means investing. Not someday. Now. So what actually beats inflation? Asset 1. S&P 500 index funds. 10.7% average annual return over 50 years. Inflation average over same period, roughly 3.8%. Real return after inflation, approximately 6.9%. That means your money more than doubled in real terms every 10 years. This is the most proven inflation-beating vehicle available to everyday investors. Asset 2. Real estate. Home values have historically appreciated at roughly 4 to 5% annually on average. Rental income on top of that. And the debt used to buy it is being inflated away while the asset grows. Asset 3. Tips. Treasury inflation-protected securities. U.S. government bonds specifically designed to keep pace with inflation. The principal adjusts with the CPI. Not a wealth builder, but a wealth preserver. Good for the conservative portion of a portfolio. Asset 4. I-bonds. Series 1 savings bonds from the U.S. Treasury. Interest rate tied directly to inflation. Completely safe. Government-backed. Limited to $10,000 per year per person. Best for emergency fund money you don't want inflation to eat. Asset 5. Dividend growth stocks. Companies that consistently raise their dividends above the inflation rate. Johnson & Johnson. Procter & Gamble. Coca-Cola. Companies that have raised dividends every single year for 25 years or more. That income stream grows faster than inflation, making each payment worth more in real terms. Now let's talk about the strategy. Most people over 30 should have the vast majority of their long-term wealth in S&P 500 index funds or total market funds. These are your primary inflation-beating engines. Your emergency fund, 3 to 6 months expenses, should be in a high-yield savings account, currently paying 4 to 5%, which at minimum keeps pace with inflation. Your HSA, invested in index funds. Your retirement accounts, index funds. Any taxable investment, index funds. And as you build toward retirement, gradually shift a portion toward more inflation-protected income through dividend stocks and tips. Here's the action plan. 1. Move your emergency fund to a high-yield savings account. If it's sitting in a checking account earning nothing, you're losing money to inflation every day. 2. Check every dollar that's just sitting in cash. Any money beyond your emergency fund that isn't invested is being slowly destroyed. 3. Confirm your investments are beating inflation. S&P 500 index funds over 20 years, yes. I-bonds, yes. Savings account at 0.5%, no. 4. Stop thinking of cash as safe. Cash is safe from market volatility. It is not safe from inflation. Redefine your relationship with risk. 5. Start investing any non-emergency cash today. Every day it sits uninvested. Inflation takes a percentage. The invisible tax never stops collecting. The invisible tax is real. And now you know how to fight back. Subscribe for what comes next. New video every week. See you in the next one.